It wasn't the sudden dip in consumer prices. It wasn't the softening of the labor market. It wasn't even the gridlock in Congress. It was the terrifying mathematics of the sovereign ledger. The pattern is unmistakable. Throughout history, every major empire reaches a specific mathematical tipping point, a moment where the central authority faces a binary choice. They can protect the value of the currency, or they can protect the solvency of the state. They never choose the currency. The mechanism is always the same. The empire overextends. Debts pile up. Inflation begins to rise. The central planners attempt to tighten conditions to halt the inflation, but the tightening exposes the rot in the system. Something breaks, a bank fails, a bond market freezes, a legion mutinies. And then comes the pause, the pivot, the surrender, the moment they stop fighting inflation to save the system from immediate collapse. This pause is not a sign of health, it is the death knell of the currency regime. History provides us with 3 perfect case studies of this exact sequence. The Roman Empire in the 3rd century, the Weimar Republic in the early 20th century, and the British Empire in 1931. In each case, the authorities tried to hold the line. In each case, the pain became too great. In each case, they paused their discipline, and in each case, the result was a flight into hard assets and the destruction of the middle class. The first clear example of this dynamic appears in the Roman Empire under the Severan dynasty. The year is 193 AD. Septimius Severus has seized the throne after a brutal civil war. The treasury is empty. The legions are restless. The cost of maintaining the empire's vast borders has become mathematically impossible under the existing tax base. Severus faces the classic central banker's dilemma. 17 centuries before the Federal Reserve existed, he can maintain the silver purity of the denarius, which requires austerity wage cuts for the army and the risk of being overthrown. Or he can pause the discipline and debase the currency. The warning sign that forced his hand was the loyalty of the military. The soldiers demanded higher pay to keep up with rising costs. To deny them was suicide, so Severus enacted the ancient equivalent of a dovish pivot. He reduced the silver purity of the denarius from roughly 80% to roughly 50%. He didn't announce this as a default, he framed it as a necessary measure for imperial security, but the market knew. Merchants in Antioch and Alexandria began to demand more coins for the same bushels of wheat. The legionaries, realizing their new coins purchased less, demanded even higher raises. This created a feedback loop. Caracalla, his son, had to debase the coin further, introducing the Antoninianus, a double denarius that contained only 1.5 times the silver. By the time the crisis of the 3rd century arrived, the silver content had collapsed to barely 5%. The pause in fiscal discipline bought the emperor's time, but it destroyed the Roman economy. Trade networks disintegrated because no one trusted the currency. The middle class, which held its wealth in savings, was wiped out. The only survivors were those who owned land, gold, or productive estates. Just like the Roman experience, the Weimar Republic offers a terrifying lesson in how political pressure forces the abandonment of monetary discipline. We often remember the wheelbarrows of cash from 1923, but we forget the pause that happened before it. In 1920 and 1921, the German government actually attempted to stabilize the mark. They implemented tax reforms. They tried to balance the budget to meet reparation payments. The currency stabilized briefly, but the cost of this discipline was social chaos. Unemployment began to rise. Right-wing assassins murdered the foreign minister Walter Rathenau in June 1922. The warning signs were flashing red. The government feared a Bolshevik revolution more than they feared inflation. The internal pressure from the unions and the external pressure from the Reparations Commission created an impossible vice, so they paused the stabilization efforts. They abandoned the attempt to fund the state through taxes. Rudolf Havenstein, the president of the Reichsbank, made the fateful decision to monetize the debt entirely. The incentives were clear. If he tightened rates and stopped printing, the government would collapse and civil war would likely ensue. If he printed, the factories kept running and the workers kept their jobs, at least for a while. He chose the pause, he chose the pivot to ease. The printing presses began running 24 hours a day in early 1920. A loaf of rye bread cost 163 marks. By September 1923, that same loaf cost 1.5 million marks. At the peak of the madness, prices were doubling every few days. The middle class, the pensioners, and the bondholders were liquidated. Their life savings denominated in paper marks could not buy a cup of coffee. The only winners were the industrialists like Hugo Stinnes, who borrowed heavily to buy mines and factories, paying back their debts with worthless paper. Just like Weimar Germany, the British Empire in 1930, one faced a breaking point where the cost of defending the currency became higher than the government could bear. This is perhaps the most direct parallel to the modern central bank pause. Great Britain had returned to the gold standard in 1925 at the pre-war parity. This was a massive tightening of monetary conditions. It was a matter of national pride and financial orthodoxy. The Bank of England, led by Montague Norman, was determined to defend the pound sterling at $4.86. To do this, they had to keep interest rates high and enforce austerity on the domestic economy. The result was crushing deflation and misery for the working class. The warning sign that finally broke their resolve came from the Royal Navy. In September 1930, the government announced pay cuts for sailors to balance the budget and defend the gold peg. The sailors of the Atlantic Fleet at Invergordon refused to obey orders. It was a mutiny. The news shattered confidence in the British government. Foreign central banks began draining gold from London at a frantic pace. The Bank of England raised rates to defend the reserves, but the bleeding continued. The political cost had become too high. The austerity required to defend the currency was causing the social fabric of the empire to tear. On September 19, the Bank of England was forced to pause its defense. They suspended gold convertibility. The pound collapsed, falling from 4.86 to 3.40 within a week. It was a humiliation for the establishment, but it was a relief for the economy. The pivot had arrived. The discipline was abandoned. Those who had kept their money in sterling bonds lost nearly 30% of their global purchasing power overnight. Those who held gold or foreign assets were protected. The pattern repeats in 7 distinct stages. Stage 1 is the accumulation of debt. Stage 2 is the emergence of inflation. Stage 3 is the tightening cycle. Stage 4 is the fracture. Stage 5 is the pause. Stage 6 is the relapse. Stage 7 is the flight to reality. Just like the British Empire in 1930, we are currently living through the transition from Stage 4 to Stage 5. The Federal Reserve and other central banks spent the last 2 years aggressively tightening monetary policy to fight the inflation surge. The arithmetic is merciless. They raised rates at the fastest pace in 40 years. This tightening cycle exposed the cracks in the global financial system. We saw the warning signs vividly. We saw the collapse of regional banks in the United States, forcing emergency liquidity injections. We saw the near implosion of the British pension system, requiring an immediate pivot by the Bank of England. The incentive structure forces the pause. The Federal Reserve cannot raise rates to the level required to truly kill inflation without bankrupting the U.S. Treasury. The interest payments on the national debt have already surpassed the defense budget. If rates stay high, the debt spiral accelerates. If rates go higher, the banking system faces a solvency crisis. Under these constraints, the rational move for the central planner is to pause. Some economic historians note that this is exactly what happened in the 1940s and the 1970s. The authorities talk about data dependence, but the only data that matters is the stability of the bond market. There is a counterargument. Some observers argue that the Fed will stay the course. They point to Paul Volcker in 1980, but the arithmetic is different today. The leverage is too high. Therefore, the pause is not a choice, it is a mathematical necessity. Subscribe to this channel, watch the bond market, prepare accordingly.